Okay, so interest rates are going through the roof, and there's talk about a recession. Well, I'm going to break it to you right now. We are in a recession. We've been in a recession all year. So, what does that mean? Well, that usually means there's less jobs, which isn't happening right now, which is probably one of the reasons why they have been saying we are not in a recession. And of course, number two is just the lack of earnings potential. And these are two major reasons why, of course, you would normally be in a recession. Well, right now, we have inflation going through the roof. We have an earnings recession in a sense. And we have the highest jobs ever, which then tells the Feds to raise interest rates. In fact, we see that right here, and that huge spike that we see. Normally, when we see interest rates rise, it's usually somewhat gradual, unless we see this happen right there. What did we learn from here that we are not currently incorporating here? A fast interest rate rise will always have a stock market crash. Now, what does this mean for us as investors? Well, myself, I'm a dividend investor. I like to invest in dividend stocks because you can generally look at, let's say, a Canadian bank and say, okay, they'll go up 4 to 9% a year, and I'll get, depending on the bank, between 4 and 6% dividend. So I can get paid, have my money grow faster than inflation, generally speaking, and I can then, of course, sit back and let my money work for me. And while this is a fantastic option, and in my opinion is still a fantastic option, because guess who makes more money when interest rates rise? It's the banks. So, in my opinion, this is still a good option. However, if you can get your money to make interest at 4% or 5% or potentially upwards of 6 or even 7% if the federal government in the United States and Canada continue to raise their interest rates, then there is almost zero risk, and you're making that 4, 5, or 6% interest. And that's always a better option than investing in something that's risky like stocks and get a 4, 5, or 6% dividend, while you could be making that with no risk at all from interest. That's actually how my grandparents made a lot of money, was back when interest rates went huge. They locked in their money long term, and they were able to make a killing. Just think. We're looking back into the 80s, and you're spiking at 20%, sitting generally around 15%. If interest rates go that high, you're going to see a massive dump in stock prices, because everyone's going to be pulling their money out, and everyone's going to be sticking their money in the guaranteed 10-15%. And do I think that we're going to reach 15%? I really doubt the Federal Reserve in Canada and the United States is that dumb. However, it's happened before. But let's face it, this close to 0% interest right here is unsustainable. We cannot sit that low for very long. This sat way too low for way too long. We did not raise interest rates early enough, should have been getting raised back here, and it should have been up past 5% by the time COVID hit, or the virus hit. And they should have never dumped it down to 0%, but they did. And now we're paying the price. The United States, Canada, and the entire world printed a ton of money. And now that money has basically, where does it go? It goes to the banks. Because, let's face it, guess who gets the money? Well, we all got stimulus, right? The Americans got stimulus. The Canadians got CERB or whatever they called it. And with that, the Canadian and the United States government printed a lot of money, gave it to the citizens. The citizens then either spend it on things, or they put it in the bank, in which case if they spent it on things, it goes to a company which then puts it into a bank. So guess who actually made the money there? It wasn't the individuals, it was the bigger corporations, because no matter what, anytime new money is printed, it doesn't matter who you think you are, it's always going to go to the person who is giving the most value or to the big corporations. Those are the two things. It doesn't matter if the government gave you $2,000 a month, because guess what? That money is going to go to other people. That's just how life works. And because that money went to other bigger people, it went to, of course, more spending, whether it's stores or whatever. And whenever there's more money, the money is worth less, in which case now we're going to be raising interest rates like crazy. I don't see that happening, though. I think that will max out around 5. That's generally the average long term. So what does this actually tell us? Well, this actually tells us that, hey, right now, while we may think about investing, if you're doing it into a stock market-wide ETF like an SPY, VOO, or whatever it may be, something along those terms, that could be a good option if you're buying a little every month. However, right now, I'm saying keep it in cash and get a little bit of interest so that when the big interest rate spikes hit, that's when you go in and get interest. And then, as soon as the stock market seems to be plummeting, which it kind of seems like it's getting near a bottom right now, in my opinion, because there's a lot of negative sentiment. I always like it when there's a lot of people saying stock market's going to zero, or stock market's going to lose another 20% after already losing 20%. Whenever stuff like that, or people start talking like that, that tells me that the negativity is huge and it's time for me to buy. But that's my own personal opinion. These are my own thoughts, and something else to really look at too, mortgage rates back in the 1980s were at 18%. And I'm going to tell you right now, for every 0.75% that interest rate goes up, you're going to be able to buy $5,000 less of a house, generally speaking. So every 0.75, which means that if we go up 7.5% from where we are at today, you will be able to not buy a $800,000 house that you may be able to afford today with a mortgage. That mortgage is going to give you $50,000 less, which means that you'll only be able to buy $750,000. So these people who may think that housing prices might plummet with higher interest are actually somewhat off. So having a 7.5% raise in interest rates would mean that it would be a 10% interest rate, roughly 10 or 11%. And if that was the case, housing prices would only go down on $1 million house roughly around maybe $65,000 to $70,000. And that's not a massive case. Now, of course, when it comes to then people and their sentiment towards buying houses going down, that could drag the house prices down a little bit further. But we also have to remember that in Canada, especially around the GTA, Hamilton area where I live, there's a housing shortage, and it's a massive housing shortage. There's a lot of buyers in the market today, as there were a few months ago and a few years ago and even before the virus that hit. And we are bringing in more and more people to this area, either for jobs or for immigration. And because of that, there's going to be more and more people coming in, and we need more and more houses. Right now, I don't think there's going to be a massive correction in housing prices in Ontario, at least. It could be across Canada and might bring the average down. But in Ontario, at least around the GTA, Hamilton area, I really doubt that we're going to see a massive drop in housing prices. While I would like to see a 50% drop so that I could get the property that I would like to have, I really highly doubt that's going to happen. Anyways, I hope that this video has helped you. If it has, hit that like button, subscribe, and I'll see you guys again next time.